All right, everyone, welcome back to another weekly roundup edition of On the Margin. Man, it feels good to say that. Mark, I missed you, my friend. I missed
you. Look, absence makes the heart grow fonder, and man, I didn't think I could like you anymore, but I do. Yeah, 2 weeks is a long time, and Jack filled in ably last week. We had a good time. But no, it's just not the same. And welcome back from Morocco. All right, so do the reveal. I got the orange pants on. It is Bitcoin Friday. I got the Bitcoin roller coaster socks going. Look, we are unchanged over the last month. We're back to this, up and down and up and down. And I think that's gonna be like that for a little while longer. And we talked about this, right? Crypto spring doesn't mean straight up. It means kind of yuck, kind of windy, kind of muddy, kind of, unclear. And I think that's where we are.
Yeah. I think it's, obviously we don't like to see the correlation to the QQQ, right? The NASDAQ fund, it's, hovering above, and I think it's continuing to trend in the wrong direction. It's above 0.7 or something now. But I think given what's going on with rates, crypto's held up surprisingly well, in my opinion. I don't know.
Well, no, absolutely. In fact, there was a funny thing, and I don't want to throw Pomp under the bus. We're friends and partners, but he did a piece yesterday, and I don't know if he did it. He might have just taken it from somebody, but basically people were saying, crypto, Bitcoin in particular, is lower volatility than everything else now. I'm like, oh God. Short duration calculations of volatility and correlation are just not useful. So Bitcoin is not less volatile than stocks now because it has been flat for the month. And, if you look over the last month, stocks are down a decent amount. They were down 10, now they're down about 6. But anyway, but the idea is directionally okay in that the volatility of Bitcoin, I think, is going to trend lower. It's not going to stay at 80 forever. No. Even though Amazon's has, and it's been okay. But I don't know. I just thought it was interesting that people were trying to focus on this, and then also someone also said correlation was back to negative. I'm like, okay, you can't do a monthly calculation of correlation. You just can't. Stop doing it.
No, I agree with you. Also, that's always been one of the little inconsistencies that I love about our space, which is we want it to be steady, right? We love when it's steady, but also we love when it's volatile and going up. And we want to have our cake and eat it too.
Oh, come on. It's so funny. It really is funny. It's an interesting dynamic. I was reading some stuff before we did this this morning that, whole article on NFT prices, no bids and down 99%. And I'm like, there's a whole bunch of collections that are down and probably never should have gone up the way they went up because there's only so much demand for, and so much actual liquidity that can go into that market. And so if everybody creates some cartoon animal JPEG, some of them aren't going to hold their value. No. But the true communities and the true platforms that get built from this idea, because the JPEG picture NFT is one use case. It's one little use case of so many use cases that are coming for NFTs. I was in Vegas this week for the Web3 Expo.
How was that?
It was solid. It was solid.
A Blockworks event, but solid.
Right? Again, that's what I was going to say. If it was a Blockworks event, it would be awesome. But it was solid, and I liked the people that put it on, and we had good speakers, real high quality speakers, not as big a crowd. Part of it is Vegas is just a bad place to host an event.
You know why people do it.
No one comes to the event. They just go play, and that's fine. But, come to the event. Come listen to the people. I got to interview Mr. Wonderful on Wednesday morning. And look, Kevin is a really interesting guy, very solid investor over the years. And he actually allowed, this was great. He actually let me title the talk, how you went from dead to me to wearing orange shoes, Mr. Wonderful's crypto journey.
Yeah.
Because 4 years ago, we were on TV together on CNBC, and he basically said, "You're an idiot, right? This is Ponzi. It's going to zero. How could you, respectable person in finance actually believe in this?" And we didn't have the video, but he let me put up a picture that showed us having this conversation. And now he just raised a $250 million fund to do Web3. And 20% of his assets are in crypto. And he was great. He's like, "Look, you're exactly right. That is exactly what I said. But I've changed my mind." And right, that's the sign of intelligence, is when you get new facts, you change your mind. But even that, and this was an amazing conversation, 45 minutes. We barely had 200 people in the room because everyone was still sleeping in, and so I don't know. That was my only beef.
Yeah, I think bear market. What people are working on in bear markets, I think, tends to have an enormous amount of signal, and I think that there's a lot of stuff to actually be very positive on.
Yeah.
We were talking a little bit. Regulators sniffing around maybe one thing to be not so positive on, But I think one of the, a couple of the narratives that we've seen talked about in our space, if you've been paying deep attention for a while, the app chain narrative and the Cosmos ecosystem, that is starting to take off. I think an announcement that got slept on a lot at the Cosmoverse in Bogota or Medellin or wherever it was earlier this past month. Atom 2.0, definitely something to pay attention to.
Yep.
And roll-ups. Roll-ups are slowly but surely working in front of our eyes and solving an enormous barrier to entry into crypto and the entire ETH ecosystem. So there's a lot of stuff to be excited about.
So much going on. I just joined Farcaster, which is this decentralized social media thing.
Yeah.
And it's mostly Web3 people. And it was just amazing. I mean, it's amazing the quality of discourse and dialogue. And look, there's a lot of great stuff being built. And bear markets are for building, right?
Yeah.
Because people actually have to. Right? I mean, you're forced to actually build because you can't just watch number go up. But anyway, I do I do love the fact still that the quality of the people is so high, and
1,000%.
the number of people, and that was interesting when I said to Kevin, what changed your mind, right? How did you go from "I hate this, you're dead to me, it's not interesting," to this is going to be where I'm going to spend most of my time? And he said really three things. He said, one, he's a Canadian. He said, when Canada approved the spot Bitcoin ETF, it's like, okay, that's interesting. that because he has respect for them, and that was good. He said, two was the fact that you saw more capital flowing into projects that were related to it, just like real venture capital coming. And then three, which was the big one, says he does a lot with the engineering groups at different schools to source deal flow, Shark Tank kind of stuff. And that was smart. He said 30% of the MIT graduating class is going into digital related businesses.
Oh my God.
That's a huge number.
I got to give a shout out to the Georgia Tech blockchain group. We've been talking to them for a little while. I am blown away by what these kids are doing, how advanced they are. And I mean, when I was God knows, when I was their age in college, I was not that focused on what I was going to be doing for my career. Luckily, I was dating someone at the time who was also a consultant. I was like, I think I'd like to be employed after school, so maybe this consulting thing could be for me. But and if you go, I see on the forums, Penn blockchain, I see them voting all the time. They get delegated to from A16Z.
Yes.
Pretty nuts. Yeah, very, very optimistic. So I want to get your take. Let's start to transition here into the slides that I've crafted for us today, because we got to talk about the CPI print that came out yesterday.
Oh yes.
I got to get your take because, Mark, I'm sure this is a basic question here, but I was just confused by the reaction here, right? So can you see my screen?
Yep.
We had a hot print. Month over month, it accelerated faster than both the markets and Fed thought that it was going to. So headline CPI that came in at the accelerated 0.4% month over month versus the expected 0.2%. Core, which is the measure that we know that the Fed pays attention to, excluding the volatile prices of food and energy. I don't know about you. I pay a lot of money for food and energy, but okay. So
It is one of the
excluding
dumb adjustments. I mean, there are a lot of dumb adjustments, but
it's right. But that is the one that the market paid a lot of attention to because that accelerated a lot. Here we can see what were the contributions to top line core. And we see actually energy has moderated in the past couple of months. So that's actually now a drag on inflation. But we're continuing to see persistent inflation in services, especially, and also food, which is a pretty big one. So what do you think, Mark? I mean, I was pretty confused by this because I've got these slides here before, but the market initially sold off, right? As soon as the print went, huge sell-off in futures, and then it rallied into the end of the day, and it ended, the S&P ended up like 2.5% or something like that. Can you explain what this is? Is this just hedge funds covering their shorts?
I can absolutely explain it, but people aren't going to like the explanation. So let's go back to go forward. The print itself, totally explainable in the sense that CPI is lagging, and it's a monster lag.
Yep.
And the yellow bar on the graph for people who can see it, which is the services component, it's just all about owner's equivalent rent.
Yeah.
Right. It's yes, housing prices went up a year ago, but guess what? They're on their way down. And I don't know if rents will necessarily follow because, we probably don't have enough rental units in the big cities. Like in the suburbs where I live, plenty of rental units. I mean, prices are falling. Yep. But it's just, CPI is just a dumb measure. It's a long lag. It has these dumb calculations. It's designed for something that isn't what people use it for. It's designed for pricing adjustments, for entitlements. And the one counter on that is, it's bad when it actually goes above 2%. Because if you think about it, if you've got Medicare, Medicaid, et cetera, indexed to this, you're trying so hard to manipulate it down, which is what they've been doing for years. Yeah. And if you follow this guy, shadowstats.com, he'll tell you that, look, if we went back and calculated this the way we did in 1990, we'd be closer to 20%. And if we calculated it the way we did in 1980, 1980 would be even higher. 1990 would probably be in the teens. So, and everywhere you go, you feel it, right?
Yeah.
You're in London today, try to go buy, a sandwich for lunch. And, I was in Vegas and, I bought lunch for myself. It wasn't even fancy, just, little, I think it was like a hamburger or whatever. It was $22.
Yeah.
For one person. I mean, come on. And yes, that's Vegas or London, but in Chapel Hill, right? I've told this, I paid $18 the other day for, tacos and a water. So my point there is the inflation number has people freaking out. But what happened on the response is the plunge protection team, right? The Council on Economic Stability, which is the plunge protection team. They just start buying futures, right? This is dark pools. This is a massive short squeeze. And you don't see up 4% days. And this was bigger than that, right? This was from down 3 to up 3 in, a couple hours. That's never happened ever in a bull market. Not once. So we are definitely still in a bear market. This is non-normal. This is intervention. And look, this is a combination of the Bank of Japan intervening in the yen and the, chancellor intervening in the pound and the gilts market where you are, which we'll talk about.
Yep.
And this is massive government intervention. Look, the night before this big jump, the Treasury Secretary, Ms. Yellen, said that she was concerned about adequate liquidity in the Treasury market.
Yeah. Did you see that came 24 hours after she said nothing to be concerned about in the Treasury market?
This is an example, I believe, of the machines have taken over, that there's no one left actually trading markets. If you look at the returns of the market, quote unquote, the market over the last 3+ years, more than 100% of it happens in the overnight when the market's closed.
Yeah, right? I saw
in
that.
The gaps. Nothing happens during the day. Now, this happened during the day because the gap open was what it should have been, right? People should have been freaked out that they've lost control, they being whoever the powers are. And I think this is, everyone was offside short. The machines put a little squeeze on, and everybody has to cover. And we'll see. Morgan Stanley had a massive miss this morning on earnings, and AMD last week had a even more massive miss on earnings. I think earnings are going to be dreadful. Although I love Twitter. So I saw somebody tweet out, well, yeah, earnings are going to be bad, but by next quarter, comps to last year are going to be easy. So then earnings will be good. Like, no, that's not how it works. You can't just say that, oh, well, because there was a bad fourth quarter last year and we'll have a better fourth quarter. So better than bad is not good. That's not how it works. But anyway.
That's a mental gymnastics there to make bad earnings be like, oh, but the base effects in 1 year, it's going to make it good earnings in a year.
Yes.
That is
in fact, I think one of the comments.
That is some Cirque du Soleil level of mental gymnastics right there.
Yeah,
that is pretty impressive.
Yeah, it was Olympic level. Yeah. And I think one of the comments was like, yeah, if we just ignore 2021, it's all good. It's like, I say this all the time. If I just ignore the fact that I have no legs, I am 6'4", right? I mean, because sitting down, I'm like 6'4". But when I stand up, I'm less than 6 feet, like, because I have these little tiny legs. But I have long torso, whatever. But yeah, if I just ignore that fact, then I can claim I'm 6'4", but it's not the way the world works.
You touched on two important points that I want to get to there. You were starting to talk about entitlements, and I just want to zoom in on that to make sure that the audience understands how important of a point that is. We basically have these liabilities as the United States, right? And that is a very real form of currency, right? That is not, so you cannot print the medical care that we have promised to people over the age of 65, right? That get Medicare and Medicaid. You cannot print that kind of stuff. And critically, those are inflation indexed, right? So that, I think what you were describing there, it's a big deal that we're getting the CPI readings that we are, that kind of there's this misalignment of incentives with the government. We have probably now, we understand that. I mean, even for me, my generation, I was told, yeah, you're not going to have Social Security. It's not viable, right? So there's this unviable policy that we haven't been honest with ourselves that it's not viable, but we really, really, really do not want to default on that, because that is going to be probably the least popular thing to default on. And it is linked to CPI. So we have this weird incentive where we want to show lower CPI ratings because that reduces a very real liability on the US balance sheet. That's what you're talking about there, right?
100%. Look, an entitlement is a promise you make to yourself that you don't fund and you ask your kids to pay for.
Yeah.
And it's awesome. And we boomers, right? We made lots of them. And, Medicare, Medicaid, all this stuff, Social Security, it's amazing that you can have all this free stuff, but you actually don't fund it. So how do you pay for it? And I've told the story before, right? My mom believes there's a little pot in Washington, D.C. of Judy's money. I'm like, Mom, there's no pot. She says, well, how do I get paid? I'm like, from me. I mean, my money is going in, my taxes are going in, and they're paying for you. And, the challenge, when I had 2 kids, I was like, yeah, the problem is when I reach retirement age, which is not that, long from now, although I'm not going to retire, but when I reach retirement age, there'll be 2 workers for every retiree. When Social Security was set up, there were 17. Good system. 17 workers, 1 retiree, no problem. 2, So that means they have to choose between my wife and I lose. So I had to have more kids. So I had another kid, and that was the end. But because can't have any more past 47. But so I'm still screwed because I only got one. And Will's awesome. So I guess I'm just going to have to make sure that Will gets a really, really, really good job so he can pay a lot of taxes to pay for me.
Yeah, that Will. No pressure, buddy.
No pressure. No
pressure, dude. Then the other point that I wanted to zoom in on that you said there was that we basically what we've had so far, the reversion in the stock market indices in the U.S., Dow, S&P, the Nasdaq, that has been based on interest rates alone. We haven't really done the adjustment based on earnings. So if you think about roughly, right, this is an oversimplification, but two major components to valuing stocks. There's the price, there's the earnings. The price, that's what we pay, is based on the discount rate. So we've got interest rates shooting up. Interest rates are an enormous input into the rate that we discount stocks back at. So when interest rates go up, we use a higher discount rate. The cash we value less in the future, so the value of the stocks go down. That's basically what we've seen so far. We have not seen a reversion in the other thing, the under the P, the earnings, because we started to see projections moderate a little bit, but that still seems like the next shoe to drop to me. What do you think about that?
Well, it's already dropping, right? I said AMD last week, horrific number, and semi stocks all cratered. Now they all went up a lot yesterday. I'm like, well, dead cats do bounce once. And so, Morgan Stanley missed badly today. I think iBanking revenue is down 55% or something. And, M&A is down, activity's down. And part of the problem is this nonsense, and we've talked about it before, of what I call, the high jump problem, right? A year ago, you told me you're going to make $1. 6 months ago, you told me you're going to make, 50 cents. Last week, you told me you're going to make 10 cents, and then you report 11 cents, and I'm supposed to be happy. That's ridiculous, right? That's take the bar off the rack, put it on the ground, jump over it, and say, "Oh, I'm the world high jump champion because I jumped over the bar." I'm like, no, you can't just lower the bar. And that's what these companies try to do. And so it'll say we have 70% plus, because it's always 70%, earnings beats this quarter. No, none of the companies are going to beat. They're going to lose to what they thought even 2-3 months ago, forget a year ago or 6 months ago. Everybody's going to come in light. And you see it everywhere. Now, I'm sure someone could come up with one or two companies that's actually, done well, divorce attorneys, something like that. I don't mean that in a flippant way, but I've heard more, unfortunately, about that is, times of stress, things get ugly in relationships, and that happens. So I think there are certain areas that probably have higher revenues and earnings, but not many.
No. I have a question for you. So we're looking here at core CPI, right? This is the Fed's preferred measure of inflation. Yep. We've got a couple of quotes here. One is from Nomura, the other is from Jamie Dimon, which is linked from Palm's newsletter. So the quote from Nomura: "Today's report supports our long-held view that inflation is much more entrenched than the market consensus and the Fed's expectations. As a result, we believe today's data supports our above consensus terminal rate forecast for 5.25 to 5.5%, including our call for 75 basis point hikes in both November and December." The market is actually pricing in now 75 basis points with a chance at 100 basis point hike in November, and they're pricing in basically a 75 basis point hike in December. So the market basically agrees with this. Jamie Dimon says, besides predicting a hard landing and a 30% crash, CEO of the largest bank said his gut told him that Fed funds rate will probably have to rise higher than the 4 to 4.5% level many economists are predicting as inflation persists. This comes back from the quote that Stan Druckenmiller gave us 3 to 6 months ago when he said, we've never gotten out of an inflationary period where we did not hike Fed funds above headline CPI. My question to you is, do you think we're going to get there?
It's such an important question. You know how I feel. Questions are always more important than answers.
Yeah.
And I'm going to stall a lot on this one because I don't really have a good sense. I know what I believe should happen, but I don't really
Give me that
have a
scenario.
good
What do you think
handle.
should happen?
What I think should happen is they should stop raising rates,
Mm,
because I believe that this is a bad measurement, right? This is
mm,
not inflation the way we all think about inflation,
mm,
right? This is not demand pull inflation. This is not even supply. In some ways, there's some supply constraints, but what it really is just currency devaluation,
mm,
right? They printed way too much money, and it's coming back to haunt us. Now, you could argue, and I would relent, that no, Mark, there has been a lot of supply disruption because of the silly zero COVID policies in China and the breakdowns of the supply chain. Yes, right. I've lamented, right. I can't get my new Nero because literally there are no Kia Niros in the United States. I mean, there's
mm.
like one in Hawaii, and I don't want to go to Hawaii to get it. But
Fair.
okay, so fine, I'll accept that. But I believe that we're mismeasuring quote unquote inflation, because it's really the impact of dollar devaluation.
Mm,
And everybody says, no, the dollar's really strong. I'm like, yeah, the dollar's strong versus the yen and the euro, which are devaluing even more. And now the pound, which is just destroying itself.
getting
But
smoked. The yen. Look at where the yen is right now. It's 146. It's above
yeah,
the rate that the Bank of
the
Japan is targeting.
yen's lost 35% of its value relative to the dollar this
That's
year.
that's
Okay.
that's
Just
a
this
big
year.
move.
That's
That's
a
a very big
big,
move.
big
Yeah,
move.
yeah.
And 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 that is because, right? And I've talked about, right? You know, a very nice house, but my house is not worth 40% more than it was a year ago. It's just
Mm,
not.
mm,
It's not. The house itself is not worth more. Someone would have to pay more because those dollars are not as good. It's like the food that I ate for lunch the other day that I paid $18 for. It's the same. It's the same 8 chicken wings I've been eating for the last 4 years at the same restaurant. But the money that I pay for them with is worth less.
mm.
That Nothing changed about those chicken wings. They don't
Yeah.
taste better. They're not better for me. I mean, some would say they're not good for you. I think they're really good because they're baked. They're not fried.
So this is what I mean, there's some pretty crazy charts. I mean, these last 2 years have been the years of crazy charts, right? What we're looking at here is the 2-year bond yield, which is creeping up above 4.5%, right? And to use your phrase, right, where the neck goes, the head will soon follow. And we know that there's a strong correlation, let's say, in between the 2-year and Fed funds rate, right? What we're looking at on the right here is the spread between the 10-year and the 2-year. This is that
Yep.
inverted yield curve that is plunging to, yeah, it's merging on the deepest level that it's been since the 1980s, right? So this is a deep inversion, and it's very predictive of, again, strong correlation with an impending recession. And this is what's causing all of it, right? So the Fed is looking at, they have expressly said this, right? This has come across in the minutes. We've heard Jerome Powell talk about this. This is when you want to see slack in the labor market, and it has remained persistently low, right? So we're looking at U.S. initial jobless claims. This is that blue thick line on the bottom. We saw a jump last week, not because of anything that's going on in the economy. It's the hurricane, right? That's happening in Florida. So this little bump up here, that's not indicative that the labor market has remained persistently strong. So I have an opinion on this. I'd be curious to get why do you think the labor market has persisted and is as strong as it is?
Again, I don't think the labor market is strong. Do you know companies making layoffs? I know lots.
Yeah, me too.
Like lots.
Yeah.
like lots.
Yeah.
And have you and everybody says, no, the labor market is strong. Everybody needs help. I'm like, no. What we're seeing is a couple of things. One, we got this, birth death problem that I talk about all the time, which is they just artificially count jobs that aren't there because they say we're in an expansion when the yield curve is clearly telling us we're in a recession, and earnings are clearly telling us we're in a recession. And, so that's that. The second is the silliness of removing people from the labor force when they turn 65 is just inane. right? I mean, that's just silly. Just because you turn a certain age doesn't mean you stop working. There are plenty of people who are still working, have to work. They don't have any choice. So I think, again, I think the data is flawed. You know, why don't we use payroll taxes to count workers? Seems like a simple solution. We have the technology to do that. Why don't we do that? I don't know. It's weird.
Yeah. You could also make the argument, even for inflation, we're talking about forward-looking indicators. Why aren't we taking data from Visa or MasterCard or any of these payment processors?
How about the Million Prices Project? A bunch of MIT engineers have a constant feed, like in real time. It monitors millions and millions of prices around the world in real time.
Yeah.
And people say, oh, we won't use that. Like, why not?
Why not?
Well, because it might be more accurate. And we don't want accurate. We want obfuscated.
So I'm speaking with Eric Bismasian later today, who's a great analyst. You guys should all pay attention. He's awesome. We did an interview back in April, and he kind of outlined these 4 stages of economic change, right? And this is how he said it played out. Stage 1, there's a change in interest rates, right? Which is a monetary acceleration or deceleration by the Fed. Then that gets fed into primarily housing, economic forward-looking indicators, right? And housing is the economy, as you and I have talked about. So we talk about it so often on this program, because it's not only the price of housing and there's the wealth effect, but it's also like, white goods and all this different stuff you sell into a house, right? Furniture, all this stuff. So it is basically the economy. Yeah. Then what that feeds into is corporate earnings, right? Because people start to feel it in their paychecks. And then the last thing is unemployment, right? So people are spending less money, that gets translated into corporate earnings, and then unemployment. It's the most, you and I talk about lagging indicators, that at the very end is unemployment. It is the most lagging indicators. The Fed is basically jamming the stick because they want to see slack in the labor market. And it's like, dude, it is happening. It's a little frightening. I got to be honest. It is a little frightening to watch play out in real time.
It is. And again, sinister Saturday. I keep trying to believe it's not intentional, right? I really don't want to believe that the powers that be want to create bad stuff, right? I really don't want to believe that. But you look at their actions and you look at the potential impact that it has. And it's everything from, how do we solve, persistently weak economic growth? We go to war. Yeah. And in every case in history, that's what we do. Well, war is bad. I mean, it's like really bad. And well, it's good for defense companies, but it's bad for human beings and populations. But here we are, quote unquote, in another war. Now, I don't really view it that way, but people spend a lot of money on defense. And then we have things like, the widening gap in incomes and net worth. Is, the rich get richer when inflation numbers are high and the poor get poorer. So if you think about the Fed's job is quote unquote price stability, right? That's supposedly their job. Well, if that was their job, then what grade do they get right now? Pretty poor. F minus? Yeah. I mean, can you go lower than F? Can we give them a G or an H? That's what they would get. And so now you can say, well, okay, Mark, well, but now they're committed to getting it back down. But all I've heard is, well, maybe we should change the target to 4. Right? Well, okay. Why? Why 4? So then we can steal wealth twice as fast from people. And so if I were really cynical, I would say, they're not really doing that much because this is the plan. Yeah. And the plan is to escalate the value of the assets at the top, which is owned by a very small number of people, all-seeing eye. I don't know. You were just near the pyramid, so,
let me present. I agree with some parts and I would push back on others. So let me just present an alternative opinion to this. I think One thing I cannot imagine the stress of running, being in charge of so many people's lives. Honestly, I mean, even
Okay.
managing payroll for some amount of people. And there was a book that came out, Paul Volcker post, his hiking in the 1980s. It's like Changing Fortunes or something like that. But it's basically a retrospective on what he felt like going through that at the time. And I have to imagine it's like you are staring into the void, man. I mean, you are in charge of the finances of the empire, right? The largest country in the world, and
Yep.
the negative consequences associated with getting it wrong are just so high. So I would, if I was putting myself in Powell's shoes, and I know everyone's speculating that this is a pride thing and it's about his legacy. I'm just going to say, Powell aside, if it were me sitting in that seat, I can't honestly say I'd be doing that much different, because what they messed up in the 70s was they would hike a little bit. It looked like it was starting to get back in line,
Yeah.
and then it didn't. And then they just elongated the problem. Basically, it led to a lost generation, right, of stagflation and continued, these very volatile bouts of inflation. And I think the most optimistic thing is to say they learned from their mistake. They want to take the medicine all at once. They shouldn't have done it. They should have started hiking and not being as accommodative last year. We know that now, but that's what I could say, maybe to push back a little bit.
Totally fair. Look, I'll say in 2013,
Mm-hmm.
right? They should have started hiking in 2013.
They should have.
And, to have emergency stimulus, the loosest economic conditions in history, 10, 12 years in to the recovery, right? The global financial crisis happened a long time ago. Now, it's funny. There's this guy, and, he has like 177 followers, so maybe he's not that influential, but he wrote this scathing piece about a bunch of people on Twitter, and he included me in there, and all about bear porn and how all these people they're always saying the negative, the world's saying. Like, no, it's not what I say. In fact, most of what I talk about
You're
on
a very
Twitter,
positive guy,
positive,
actually.
right? Actually, most of it's
Knowing
positive.
you, you're
Just
very
I
positive.
happen to be, I do happen to be negative on the economy right now, because I think the economy is doing really poorly on every measure, and I think the stock market is doing poorly, right? I mean, it is down 25%, and stocks and bonds together are actually having the second worst year in history, behind 1931. And so he took offense to my use of global financial crisis too, my hashtag GFCII. I'm like, we're in that. I mean, look at the definition of financial crisis, right?
Yeah.
What does that mean? Well, that means
Yeah.
that prices are down a lot, which they are. It means that economic growth is down a lot, which it is. It means there's some sort of turmoil in liquidity and functioning of the markets, like the UK pension system being bankrupt and having to be bailed out overnight on a Sunday, which is when it happens.
Crazy.
So, and the fact that the Great Depression, right, 1931, was the only time when markets are worse than they are today, you would have to at least acknowledge that it kind of looks like and feels like a crisis. Now, you can say, well, but you shouldn't point that out because you'll make people afraid. Oh, no, I think we should talk about it. We should have dialogue and debate about it. We should, have the discussion about, well, what could make it better? I mean, could the Fed actually fix it? And this goes back to what I've said over and over on the show. How many interest rate hikes are going to change the price of natural gas to Europe from Russia?
Mm-hmm.
Doesn't matter.
It doesn't. Yeah, it doesn't matter.
How many interest rate hikes are going to change the price of wheat coming out of Ukraine? Doesn't matter. How many interest rate hikes are going to change the zero COVID policy in China and open up their borders? Doesn't matter. So I don't believe that the Fed, we just awarded the Nobel Prize.
I saw that. What?
To
I mean,
Ben
that actually, I gotta admit, that one
Bernanke.
made me turn my head. How tone deaf could you be? I mean, that I thought was really
It's bizarre
surprising.
on
It's bizarre.
so many
It's
fronts.
bizarre.
I mean, it's just bizarre and stuff. But remember, he was elected Times Man of the Year.
Yeah.
Right. And here's the thing. I've said this before too, right? My friend said, I remember a day when I couldn't tell you the names of the head of the central banks.
Yeah.
I long for that day to return.
Mm.
And as long as we put these people on a pedestal and we give them the power that you describe, right? This all-knowing, all-being oracle power, the market knows best, right? The 2-year is telling us that the Fed is quote unquote behind the curve.
Yeah.
The inverted yield curve is telling us that we are about to have a recession at least as bad as the 1980s when, where I grew up in Seattle, there literally was a billboard with the last person to leave, please turn out the lights. It doesn't necessarily have to be the Great Depression, but we're one policy error away from that, because that's how depressions happen, right? You make a policy error and recessions turn into depressions.
Mm. You know what I was just looking up as you were saying that, what the Bernanke thing reminds me of, which, by the way, I think it's fair to say he should have done QE when we really needed it, when we were in the depths of a crisis, right? But QE1 became QE infinity. And that's an important distinction to make. And what I was thinking about when we were talking about Ben Bernanke getting the Nobel Prize and all this stuff is, do you remember that Time magazine? There was a Time magazine cover of Alan Greenspan and Rick Rubin in 1999 or something like that. And it was, the Committee to Save the World.
Yeah, exactly. The Committee to Save the World, the plunge protection team. Yeah.
Yeah. And it's like, man, well, what do we do? It's slowly eroding. All the incentives are just wrong. Lynn Alden had this great tweet that really made me think. It's part of a longer thread. We can link it in the show notes. But ironically, a lot of people that dislike active portfolio management because it's statistically very hard to do successfully heavily endorse active management of the root layer of the global financial system because that's not harder. Seems like a positional conflict to me, which is so true.
That is the best. It is the best, and it is real. Yeah.
So then, if we need the manager of base money to essentially be the best active hedge fund manager of all time consistently over periods of hundreds or thousands of years, because that's how long we want the United States to endure, that is poor governance. We have the wrong governance system in there to manage base money. Mm-hmm. It's poor incentive.
But again, that goes to maybe that's not the goal, right? Maybe the goal isn't this, long-term stability and long-term, superiority. Maybe the goal is, as I have described, that the purpose of central banks is to make bankers and rich people rich. It has been since 1607 when the Rothschilds created the first one. There were no central banks before then. And there wasn't even a central bank in the United States until 1913. And why was that? A bunch of rich people, decided that they would import this model, right, from the Bank of England, which imported it from the Bank of the Netherlands National Bank. And it's just frightening when you think about how these small number of families, Rothschilds, Morgans, etc., have been and currently are in charge. I know we talked about this before, but I love the picture of the Bilderberg board seats. So there's this thing called the Bilderberg Society, and it meets once a year, and it's all these highfalutin families, and the members, right? It's public. It's a list, and so this guy every year goes through and takes that list and then draws a picture of all the companies that these people sit on boards of with all the interconnections. Your mind will blow if you Google this picture. And
what should I Google? Bilderberg.
It's called, the Bilderbergs. And then it's like a corporate board, cluster diagram. But if you just do the Bilderbergs and search images, it'll come up. But it's really unbelievable that the same small number of people run every company, sit on every board, they trade board seats back and forth. I mean, it's really, and then what we get from that, this is my personal pet peeve. So this morning, someone tweeted out the picture of, they rated foods on, according to, the health administration, right?
Mm.
attractiveness of certain foods. And at the top of the list, watermelon was number one, followed by like frosted mini wheats, and then a couple, and then Honey Nut Cheerios, and kale. Kale was number two, and then it went down into some other stuff, and at the very bottom was ground beef. I'm like, on what planet is eating Honey Nut Cheerios better for you than eating a hamburger? There's no planet anywhere in the world. But why would that be? Well, then the next picture was the picture of the 4 food companies that run the world and all the processed things that they sell us. And then we wonder why we have an obesity epidemic and a diabetes epidemic and a heart disease epidemic. It just makes me angry. And it's all about the money.
Yeah. Can I give you I was one of the things I did on this vacation, Mark, I listened to a great book. It's called Rubicon. I read this a while ago, and it's an in-depth kind of historical fiction, but it's really based on it's all the fact, right? That this guy tries to accumulate, and then he puts a narrative on it of the 100 to 200 years of the transition from republic to empire in Rome. So really, really interesting. He talks about all the major characters. Let me give you an example of something that starts out as a good, honest idea, but translates into something that's very corrupt. So there was Rome in the beginning, they didn't have this great administrative body that they would later have in empire. So when they start to, go out and do these fights, right? This was a whole part of their culture. It was virtue and glory. That's what they were pursuing. They wanted to war with other people. They didn't have a good system for administering taxes and putting them into part of the empire. So they're kind of stumbling with this. And what happens is some king, because he wants to get on the good side of Rome, basically takes it to the logical extreme, Pergamum. He gifts upon his death the entire kingdom to Rome. And it's so much money. It's an enormous amount of money. They don't have any good system to collect this. So they come up with this system called the Publicani, which was supposed to be a bridge system in between. So basically, funny system how it worked. You would say, okay, how much taxes do we think Pergamum can extract? Okay, let's say I'm using dollars here, but let's say it's $2 million a year. They would get someone to front Rome $2 million a year up front. Then you go and you collect the taxes, and whatever you make on top of that, you can basically keep as a thank you for your efforts. And you get basically interest, because we're going to treat this as a loan that you made to Rome. It was an honest attempt to, hey, we don't have an administrative body in place. We got to go figure this out. So this seems like a good break. And it ends up being so successful, right, that it's what everyone wants to do, right? And you start to go out, and everyone wants to be the Publicani, and they want to collect all this enormous tax burden. And then the senators, who are supposed to be separate from this, you know what they actually create? They create shares. So the Senate can't participate. They can't be a part of this. But what they can do is they can own shares in the company. So that's the system. And actually,
that's exactly what happens now
in
Congress.
And I looked this up. This is crazy. There was one of the earliest system of limited liability corporations that they invented back then. You know how they did it?
No.
They would create a corporation, and they would put a slave in charge, because a slave is already property. So if there were to default, what are you going to do? Your recourse is to a slave, and they're already enslaved.
Oh,
I mean, that's messed up, obviously, but isn't that unbelievable?
No, I mean, look, it's the origin of Pelosinomics. I mean, wow, that is amazing.
I just love these stories, because it started off as something that was an earnest, genuine attempt to solve a problem, and it probably worked reasonably well for a period of time, because Rome didn't have to put up any capital. Basically, they were pushing off. They're basically taking variable, and it ended up almost. It was too successful.
The far-off kingdoms were far off, right?
Yeah.
You didn't know how to navigate, but when you incentivize people,
they'll do the thing.
You will get action.
I agree.
And you think about that, right? If I get everything else, and I've been given this mandate from the emperor that I can go collect taxes, I will extract some rents, baby.
I will say, yeah, they will. And they did. And everyone had their, whatever it is, their hand in the coffer or in the cookie jar. And it degenerated into a really poor incentive structure that ended up biting them in the butt big time.
Well, and then what you also then create is this problem of, well, wait a minute, if he's owning a piece of that Publicon, well, then I need to have my own Publicon. And
right. So the connection that I would make, right, to these like Committee to Save the World, Times covers, and what Bernanke did, there's a really strong part of that which is very justified, right? If you can avoid enormous pain and suffering, structural damage, enormous ailment, that's a good thing. But then it gets taken too far, right? They get the magazine covers, and oh my God, this works so well. Like we should just do it a little more. And they know in the back of their minds that the downside of this is, I don't believe that they are unaware that it's creating wealth inequality. I just don't believe it. But it seems it's very you see how it's very easy to justify, right? You can see how it's easy to justify.
Michael, the nonsense of we don't know, we're not responsible. Of course you know. And here, look, these people are PhDs, right? Fed's full of PhDs.
Yeah.
Now the fact that they're over 287 or whatever it is on estimating GDP 1 quarter out is comical, right? I can flip a coin and be right half the time.
Yeah.
So the fact that they can't come up with a number with all these PhDs, but at the end of the day, someone also tweeted out the other day, here we're giving out these prizes for economics, and the head of the Fed is a lawyer, and the head of this entity is a lawyer, and the head of this is a historian, and there are no PhDs in economics. They are, lawyers and bureaucrats, and they've never held real jobs. They've never put together a limited liability corporation. They've never had employees. They've never had to deal with the actual economics and the system in which they are trying to keep intact. And I'm as big a opponent of price fixing as anyone on the planet, right? I think all forms are bad, everything, including minimum wage, all of it. If you control prices artificially, you're wrong, right? The market does a better job. The market does a better job. And it doesn't mean I'm against social safety nets and all that stuff, but when prices are formed, they should not be set by human beings.
I'm in agreement with you.
Price of money, price of labor, price of goods, prices should be set by markets.
Mark, I know we've got limited time here and we haven't talked about the gilt situation at all. So this is an unfolding situation, but it looks like the chancellor has been sacked. This was rumored and now it becomes, fact.
You sound like such a good Brit over there in London. Chancellor was sacked.
Yeah, sacked. Yeah,
I don't get to say
the list.
Brilliant. It was
brilliant. List, mate. Brilliant. Yeah.
Brilliant.
Sorry for offending our UK audience here. But he got sacked, right? So he's out of office. But basically, the situation that unfolded last week was there was a new mini budget that was planned and it was going to be highly inflationary, right? It basically amounted to tax cuts. Ultimately, not actually a horrendous idea to stimulate an economy. I didn't think it was particularly bad. The strong reaction to it came because they had a 10 handle on inflation. So you do not want to be rolling out accommodative stimulatory measures when you have 10% inflation. Seems obvious to the market. The market puked basically on that, right? So you had gilt's historic sell-off. The Bank of England had to step in, basically restart QE on some kind of limited basis to save the pension funds, which we've covered quite a bit. Can you give us, and now it looks like they are doing a complete 180, right? The trust plan that she's rolling out is actually going to raise taxes. And it looks to me, I wasn't around for this. I actually wanted to ask, are we watching the bond vigilantes? Are they coming back? This is a thing I just heard about, right? I mean, this is, can you give us a history lesson here? Like, what are bond vigilantes? Do you think that's what's happening here or no?
That's very interesting. It's very interesting. I mean, bond vigilantes is of course the construct that there are, market participants, back to my believing markets should drive things, that keep a regulator on the prices of bonds and interest rates. And that, if they get out of whack, the vigilantes come in and force the rates in the opposite direction, or prices in the opposite direction, and which affects rates. And I struggle with this one because if you think about what happened, right? You had reckless investment banks selling products to, I don't want to call them unsophisticated, because there are some sophisticated people at some of these pension funds, but by and large, they're not at the same level of sophistication in derivative structures as the people selling.
Yeah.
Right. And so, it's like when Goldman used to come in and this was 15 years ago, and they were selling people on inflation protection, and they were going to give you these free options. Literally, they were free. Now they were skimming 4, 5, 6 points off the back end by running it through their system. But what did inflation do the next 10 years? Well, it went straight down because there was no threat of inflation 15 years ago, and demographics and all of it. But go and make a ton of money, and bunch of endowments and foundations and pensions lost a lot of money. And you had the famous Orange County thing, right, where they were selling derivatives back, and this was 20 some odd years ago, and on mortgage bonds, and blew up on people. A guy lost his job, and Orange County almost went bankrupt. So now you got the same thing. They sold them these crazy leveraged structures on gilts, and I think gilts are down 52%.
An enormous amount. Yeah.
So you think about that. If you're down 52%, it's bad. If you're down 52% and you have leverage, it's way bad.
Yeah.
And so I think you've got a situation where there was no choice. I mean, you can't let all of the pensions and the endowments and foundations be effectively bankrupt, especially if you caused it. So I think you had to, how should we say, encourage the central bank to come to the rescue yet once again, and then they'll give them a prize for being so magnanimous and brilliant. But
it's been pretty wild to watch that figure of how down gilts are. They're down more than Bitcoin is on the year. Pretty startling.
Yeah, exactly.
Yeah.
So, well, and to that point, right? The only people that got hurt, not the only people. I mean, the people got hurt the worst in Bitcoin were the ones that bought it on leverage, because they got liquidated. If you didn't buy on leverage, you're still holding, and you're down, but maybe you bought a long time ago and you're up a lot. I mean, but even if you bought 1 year ago and you didn't have leverage, you could still hold it. But if you had leverage, gone, zero.
Toast. Leverage is a tricky beast, that's for sure.
It's a totally fine tool if you don't have daily mark to market, right? Mortgage on your house is way easier to manage than a margin account. But also it depends on the vol of the asset. Don't lever high vol assets. Now people would say, well, gilts aren't high vol assets.
This year they have been.
No, they're not, except when they are.
Yeah.
And they are because you had so many derivatives contracts tied to them. It's like literally winding a spring, right? The tighter you wind it, when it finally goes, it goes.
Yeah.
And I think that's where a lot of economies around the world are right now, is they're tightly coiled springs that are about to unwind.
Yeah.
And so I think we're going to see more of this restarting of QE and more printing. And when it happens, and I've said this, right? When the Fed finally relents, the face melter of a rally in risk assets is going to be a thing to behold. Now, I think it'll be temporal because things will be really bad. But boy, the short term, it'll make yesterday or 2 days ago look look like a war on
Nothing.
back.
This is my closing question to you here for this week is the U.S. is basically exporting inflation, right? And some countries we care about exporting inflation to less than others, but it's beginning to hit our allies, right? Allied countries, especially now that we've got this geopolitical tension. It's hitting Japan, it's hitting
Yep.
the UK, the EU. Is there ever a world? I know there are no voters overseas, and we protect domestic policy, and it certainly looks like that's what the Fed is doing. But is there a level of din, right? Are there enough phone calls that the head of the ECB and the whatever can make to Jerome Powell that makes him say, yeah, you know what, maybe I've put our allies in enough pain, and I'm going to have to do something, right? Maybe it's not easing on interest rates, but it's opening up swap lines and giving liquidity that way, or doing whatever. Do you think there's a level of pain?
I do. And I have a little bit of a theory on this too, which is, every February when, the WEF crew gets together,
Mm-hmm.
all these groups, the G7 bankers, go to this event and they all meet. And I don't know if they do it by drawing straws or if they do duck, duck, goose, but they decide, and maybe it's actually an active decision, but they decide who's on the hot seat, meaning whose currency is strong. Because no one wants a strong currency. No exporter wants a strong currency.
No.
So I literally think maybe they arm wrestle. I don't know what they do in the back rooms of WEF, but actually bad stuff. But somebody gets on the hot seat. So if you go back and you look year by year, it always starts around that February timeframe. Somebody starts to rally, whether it's the euro, whether it's the yen, whether it's the dollar, whether it's the renminbi. And I think it was our turn in the hot seat this year. And so the dollar has been rallying versus everything else. I think that probably changes up again in February. So I don't know that there's enough calls to change that until they get together again, would be my thesis. But it's just a thesis, and I can be totally bonkers.
Yeah. All right, Mark. Really missed this, man. It's been really good. A ton of fun seeing your face again this week.
Great to have you back. Great to see you looking good and rested.
Thank you.
And ready to go. Congrats on Das London. I'm hurt that I wasn't invited. No, I'm just kidding. Just kidding.
We rely on you for a lot. I don't want to impede too much on your time, but
I'm just kidding around. I do love London. It's one of my favorite towns. But I do anything for you guys anywhere. So just remember that.
I appreciate it, my friend. Mark, as always, best hour of my week. I will see you here
Have a good one
next week.
See y'all.